Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into Monroe Capital Corporation's latest quarterly report, and let's just say their investment portfolio has seen some interesting movements, especially with a major shift in ownership on the horizon. Stick around because we're going to decode what all these numbers really mean for the company's future. Before we jump in, if you love getting the real story behind corporate filings, make sure you subscribe and hit that notification bell. We also have a fantastic community over on Discord, linked in the description below, where we break down these documents together. Let's get straight into the meat of this filing. Monroe Capital Corporation's quarterly report. First off, they've got a lot of shares out there, over 21 million as of August of 2025, which is important context for understanding their financial performance on a per share basis. Looking at the assets, investments are the name of the game, and they've got a substantial amount. Over $367 million at fair value as of June 30th, 2025. But what's really interesting is the drop in total investments compared to the end of 2024, a decrease of almost $90 million. This signals a significant shift in their portfolio, likely from sales and repayments, which we'll dig into in a bit. The gap between their fair value and amortized cost is something to watch. A smaller gap can indicate assets valued closer to what they paid, while a larger gap can suggest unrealized gains or losses. A huge chunk of their investments, over $61 million at fair value, are in non-affiliated companies. This is where most of the action seems to be. On the liability side, debt is a major factor. They have over $208 million in total debt after accounting for those issuance costs. This is a substantial amount, and understanding how they manage this debt is key to understanding their financial health. Their total liabilities are around $215 million, with debt being the dominant part. And when you peel away the liabilities from the assets, you get their net assets, which stand at about $179 million as of June 30th, 2025. This is down from nearly $192 million at the end of 2024. This translates to a net asset value per share of 8.29 cents as of June 30th, 2025, down from 8.25, down from 8.85. This drop in net asset value per share likely reflects those changes in their investment portfolio and overall market conditions. Now, let's look at how they're actually making money or not making money in the statements of operations. Total investment income took a noticeable dip from about $30.8 million in the first half of 2024 to $21.5 million in the first half of 2025. That's a roughly 30% drop. This is a big headline number and signals a tougher operating environment. Their expenses also decreased, which is good news. Interest and debt financing expenses went down from over $11 million in the first half of 2024 to about $8.6 million in the same period of 2025. This is likely due to their lower debt levels and perhaps more favorable interest rates on some of their borrowings. Overall, operating expenses saw a similar reduction, which helps soften the blow from the drop in income. But despite managing expenses, their net investment income also fell from over $12 million in the first half of 2024 to about $7.4 million in the first half of 2025. This really highlights the pressure they're under. On the gains side, they had a net realized loss of about $361,000 in the first half of 2025, a reversal from a net realized gain of $510,000 in the prior year. And then there's the unrealized part. They saw a significant unrealized loss of over $8 million in the first half of 2025, compared to an unrealized loss of about $6 million in the same period of 24. This means the market value of some of their holdings decreased during these periods. Putting it all together, their net increase in net assets from operations went from a positive $6.4 million in the first half of 2024 to a decrease of nearly $1.4 million in the first half of 2025. This is a pretty significant swing and shows a tougher financial quarter and a half. Now let's get specific and look at their actual investment portfolio. This schedule is like a company's treasure map, showing you exactly where their money is invested. The bulk of their investments, that's over $261 million at fair value, are in companies that are not affiliated with them. This is where the real story of their market exposure and risk lies. A massive $48 million of these are in senior secured loans. These are supposed to be the safer bets in their portfolio, meaning they get paid back first if a company runs into trouble. Looking at specific companies, they have several loans to Hastings Manufacturing Company It's common to see multiple loans to the same company, often with different terms or for different purposes. Their auto sector investments like BTR Opco LLC and Lifted Trucks Holdings LLC also show significant amounts. The footnote here is crucial because there is no readily available market value for these investments. The fair value of these investments is determined in good faith using significant unobservable inputs by the valuation designee. This tells us that the values they report might not be exact market prices, but rather estimates based on some educated guesses, which brings a layer of uncertainty. And look at the exposure. For instance, Lifted Trucks Holdings LLC represents 3.8% of their net assets, just with one loan. When you start adding up these percentages, you can see where significant portions of their business are concentrated. Then you have their investments in non-controlled affiliates, totaling over $76 million. When a company owns 5% or more of another company's voting stock, it's considered an affiliate. This can create both opportunities and risks. They have a very large investment in American Community Homes Inc. over $8 million at fair value. This represents a significant 4.6% of their net assets, showing a notable concentration in this affiliate. And finally, they have controlled affiliate investments worth about $30 million. Control means they own more than 25% of the voting securities. A big chunk of this controlled affiliate category is their 50% stake in MRCC Senior Loan Fund 1 LLC, valued at over $30 million. Remember, this is an unconsolidated LLC, meaning they don't fully include its financials in their own reports, but they do have significant influence and exposure. Summing it all up, their total investments come to about $367 million at fair value, a significant decrease from $457 million at the end of the previous year. This reduction indicates a strategic move, perhaps to de-risk or reposition their portfolio. Looking at their debt again, it's down considerably from $291 million to $2,008 million. This deleveraging is a positive signal, suggesting they're reducing their financial obligations. The decrease in net assets from $191 million to $179 million highlights the impact of the unrealized losses and reduced investment income we saw earlier. It's a reflection of tougher market conditions impacting the value of their holdings. Focusing on their senior secured loans of $270 million, representing over 73% of their portfolio at fair value. These are their core holdings. About $177 million of these are valued using level 3 inputs, meaning they rely heavily on management estimates and models, which is a key risk factor. For these level 3 investments, they're using techniques like discounted cash flow, with EBITDA multiples and market yields being key unobservable inputs. For example, their EBITDA multiples range from 5 times to over 34 times, showing a wide variation in how they value these private companies. A 100 basis point increase in interest rates, for instance, could decrease their net investment income by over $1.6 million, highlighting their sensitivity to rate changes. On the legal front, the company states they are not subject to any material pending legal proceedings beyond the usual routine matters. This is generally good news, suggesting no major lawsuits are currently weighing them down. But what definitely stands out is the news about a potential merger and asset sale. On August 7, 2025, they announced a merger agreement with Horizon Technology Finance Corporation, or HRZN, and an asset purchase agreement with Monroe Capital Income Plus Corporation, or NCIP. This sounds like a big strategic shift, and it's going to be traction our stockholders will receive will definitely depend on the market price of HRZN stock at the time of the deal. This phrase from their schedule of investments is a red flag. It means a significant portion of their value is based on estimates, not market prices. This is a common challenge in private lending, but it's always good to be aware of. They also provide details on their distributions to stockholders. It looks like they've been paying a consistent $0.25 per share quarterly, which is important for income-focused investors. Let's go back to the financials, specifically investment income. For the 3 months ended June 30th, 2025, interest income was about $6.8 million, down significantly from nearly $12 million in the same period of 2024. This drop is a major story here, likely due to a combination of fewer investments, lower interest rates, and possibly some troubled companies in their portfolio. Operating expenses also fell, which is a positive sign that they are managing costs effectively. Interest and debt financing expenses alone dropped by almost $2 million for the quarter. Even with cost savings, net investment income took a huge hit, nearly halving from 6.5 million to 33 million for the quarter. This shows the real pressure they're facing in the current economic climate. And the unrealized losses are substantial, over $5 million for the quarter. This suggests that a good chunk of their portfolio isn't performing as well as they'd hoped, or at least the market perceives it that way. The bottom line is that for the June 2025 quarter, they saw a net decrease in net assets of almost $1.9 million, a big turnaround from a positive gain of $3.2 million in the prior year's quarter. This is probably the most important takeaway from their results. Now looking at these results more broadly, Monroe Capital Corporation is clearly navigating a challenging market. The decrease in investment income and the rise in unrealized losses point to underlying issues within their portfolio, possibly concerning credit quality or general market sentiment towards their investments. While they've managed to reduce debt and control some operating expenses, the significant drop in net investment income and the negative impact on their net assets due to unrealized losses are key weaknesses. The most notable risk factors revolve around the proposed merger with HRZN and the asset sale to MCIP. These transactions, if completed, could lead to significant changes for the company and its stockholders. The valuation of their Level 3 investments, which rely heavily on estimates rather than market prices, adds another layer of uncertainty. The drop in their asset value per share in just one quarter is also a concern. On the positive side, their efforts to reduce debt are a strength. Their dividend payments, while reduced per share compared to last year, are still being made, which is important for maintaining investor confidence, especially if they can continue to qualify as a Rise C. For now, the overall story is one of a company facing strong headwinds in its investment portfolio, leading to lower income and unrealized losses. The upcoming merger and asset sale are critical events that will shape the company's future. We'll have to keep a close eye on how these major transactions play out and how the new ownership structure impacts their investment strategy and performance in the coming quarters. Alright, that's our breakdown of Monroe Capital's latest filing. What's your take on these numbers and what they signal for the company's future, especially with these big merger and asset sale plans? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description to connect with us and other viewers. Thanks for watching. See you next time. Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into Monroe Capital Corporation's latest quarterly report, and let me tell you, it paints a picture of a company navigating some choppy financial waters while also preparing for a major shakeup in ownership. We've got some interesting numbers to unpack, so let's get right into it. And hey, if you love getting the inside scoop on corporate finances, make sure you're subscribed and hit that notification bell. We also have a great community over on Discord, linked in the description, where we break these things down together further. First off, as of August 2025, Monroe Capital Corporation has over 21.6 million shares of common stock out there. Knowing this is key when we look at their financial performance on a per share basis later on. Let's start with the big picture, their assets and liabilities. As of June 30th, 2025, their total investments stand at just over $367 million at a fair value. Now compare that to the end of 2024, where it was almost $457 million. That's a decrease of almost $90 million in just 6 months. This tells us they've been actively selling off investments or having them paid back. Notice the gap between their fair value and amortized cost. For their total investments, the fair value is about $367 million, but the cost they originally paid was closer to $415 million. This difference can give us clues about how the market values their holdings, and it looks like there's a gap there. The big story in their investments is that over $261 million of it is in companies they don't control or aren't affiliated with. This means a large chunk of their financial health relies on how well these external companies are doing. On the other side of the balance sheet, their debt is significant. They owe over $290 million. Managing this debt is a huge part of their financial strategy. In total, their liabilities are around $215 million, with debt making up the vast majority of that. When you subtract their liabilities from their assets, you get their net assets, which are about $179 million at the end of June 2025. This is down from just over $91 million at the end of 2024, suggesting a tougher period financially. This translates to 8.29 per share in net asset value. That's down from 8.85 per share at the end of 2024. This drop per share is a key indicator of how their overall financial performance is affecting the value for each stockholder. Let's shift gears to how they actually performed from an income and expense perspective. Total investment income for the first half of 2025 was about $21.5 million. That's a pretty big drop from roughly 30.8 million in the first half of 2024. This decrease is substantial and tells us that fewer of their investments are generating as much income as before. On the expense side, interest and debt financing costs improved. They were about $8.6 million in the first half of 2025, down from nearly $11.3 million in the same period of 2024. This is good news, likely due to lower debt levels and perhaps better interest rates. Overall operating expenses also decreased, which is a positive sign as they manage their cost better. However, even with lower expenses, their net investment income saw a significant drop, falling from over 12 million in the first half of 2025. This is a critical number, showing that despite cost control, the income they are earning is down considerably. When it comes to selling investments, they actually had a net realized loss of about $361,000 in the first half of 2025, a turn from a net gain of $510,000 in the first half of 2024. And looking at the change in value of investments they still hold, they recorded a large unrealized loss of over $8 million in the first half of 2025. This means the value of holdings they haven't sold yet went down by that amount. When you combine all these factors, the net result for the first half of 2025 was a decrease in net assets of about $1.3 million. This is a sharp contrast to the first half of 2024 when they saw an increase of over $6.4 million. Clearly 2025 has been a more challenging period. Now for the detailed breakdown of their investments, the schedule of investments. This is where we see the specifics of where their money is. As we noted, the majority of their investments, over $61 million at fair value, are in companies they don't own a controlling stake in. The largest portion of this is in senior secured loans, which are the least risky types of loans they offer because they are supposed to get paid back first. These amount to over $270 million at fair value. You can see specific companies like Hastings Manufacturing Company appear multiple times, indicating they have several different loan agreements with them. See this percentage here, percent of net assets. For Hastings Manufacturing Company, one loan represents 1.1% of their net assets. When you look across the whole schedule, you can see how concentrated their investments are in certain companies or industries. Then they have investments in affiliates, that's companies where they own 5% or more of the voting stock. This is quite a substantial amount, over $76 million. Their investment in American Community Homes Inc. is significant, valued at over $8 million, making up 4.6% of their net assets all by itself. This shows a notable concentration within their affiliate holdings, and their controlled affiliates, where they own over 25% of the voting stock, are worth about $30 million. A big chunk of that controlled portfolio comes from MSCC Senior Loan Fund 1 LLC, where they own 50% of the equity interest, valued at over $30 million. This is an important affiliate relationship to monitor. Across the board, their total investments have shrunk from $457 million to $36.7 million. This is a clear trend of divestment or repayment. And remember that debt we looked at earlier? It's down from $291 million to $208 million. This reduction in debt is a positive step towards improving their financial flexibility. Their net assets have also decreased, confirming what we saw in the income statement. The overall value available to stockholders has gone down. Now let's zero in on how they value these investments. Senior secured loans, unitranche loans, junior loans, and equity investments are all valued. But look at this footnote. Because there is no readily available market value for these investments, the fair value of these investments is determined in good faith using significant unobservable inputs by the valuation designee. This is a critical point. A lot of their portfolio is valued based on estimates, not actual market prices. This means the fair value numbers can be more subjective and potentially volatile. For these level 3 investments, they use methods like discounted cash flow, relying on things like EBITDA multiples and market yields. For example, their EBITDA multiples can range wildly from 5 times to over 34 times. This shows the uncertainty in valuing these private companies and a shift in interest rates, even by a small amount like 100 basis points, could impact their net investment income by over $1.6 million. That's a significant sensitivity to interest rate changes. On a more positive legal note, the company mentions they aren't facing any major lawsuits beyond the usual routine matters. That lack of major legal troubles is generally a good sign for stability. However, the biggest news likely revolves around their future. They've announced a merger agreement with Horizon Technology Finance Corporation and an asset purchase agreement with Monroe Capital Income Plus Corporation. These are major events that will significantly change the company's structure and ownership. The market price of HRZN stock, which is what our stockholders will largely receive in the merger, could swing quite a bit, meaning the final value received by stockholders might be very different from what it is today. This phrase, which we saw in the investment schedule, again highlights the reliance on estimates for valuing a large portion of their holdings. This is a risk factor that investors always need to keep in mind. They are continuing to make distributions to stockholders, paying $0.25 per share quarterly. This is important for investors who rely on regular income. Let's revisit the income statement. Interest income, specifically for the quarter, was about $6.8 million, a big drop from nearly $12 million in the same quarter last year. This decline is a major signal of the challenging economic conditions impacting their lending business. On the expense side, they're doing a better job of controlling costs, with operating expenses decreasing for the quarter and year to date. But despite managing expenses, the drop in income means net investment income also fell sharply, from $6.5 million in the first half of 2024 to just $7.4 million in the first half of 2025. This indicates that the core business income generation has weakened, and that huge unrealized loss of over $5.2 million for the quarter really underscores the difficulty in valuing their portfolio in the current environment, and the market's perception of risk in their investments. The end result for the June 2025 quarter was a net decrease in assets of almost $1.9 million. This is a substantial negative turn from the $3.2 million increase in the same quarter of 2024. Now, looking at this all together, Monroe Capital is facing significant headwinds. Their investment portfolio income is down, they're taking hits from unrealized losses, and their overall net assets have decreased. While they've managed to reduce debt and control some expenses, the core issue is the pressure on their investment income. The proposed merger and asset sale are massive events that will redefine the company's future, and the reliance on estimated values for many of their investments adds a layer of significant risk. However, their efforts to manage debt and maintain distributions, even with reduced income, are positive points. The key takeaway here is that 2025 has been a tough period for them, and the upcoming strategic transactions will be crucial for their path forward. What's your take on Monroe Capital's performance and these big upcoming deals? Let me know in the comments below. If you found this deep dive helpful, give this video a thumbs up and subscribe for more. And definitely check out our Discord link in the description. It's the best place to connect and discuss these filings. Thanks for watching, and we'll see you in the next one.